So a quick introduction on myself. I'm Christian Grobe. I'm one of the founders and managing directors of ZenCap. And ZenCap is the leading marketplace for business loans in continental Europe. So we are coming from the new hype Fintech sector, and I will dive deeply into that a little later, but I will start out in explaining what led me to becoming a startup guy in Berlin. So where did I start out and how did I end up here? So I started out as a political scientist. I was studying in Heidelberg, political science and economics. I was there graduating in 2006, then went on to Princeton University, where I was a senior researcher for political science. And I always wanted to become a professor. So that was always my plan to be a professor in the university. So that's why it's very nice to be back in old university like walls. But then everything, as it happens quite often, came differently. So what happened, McKinsey, the big consulting firm, crossed my way while I was in the States. And I was visiting an event of them, and I thought, why not do it for 2 years, get a little bit experience in business consulting, and then return to university, because they have that nice program where you can do your PhD and you're fully paid by them for at least a year and can stay away for 3 years and don't have any obligations to come back. So I thought, why not do it? So did it, started out in Frankfurt in 2008 doing classic business consulting, and then went back to university in 2010 to FU Berlin, here in the western part of the city, in the south, and did a PhD in political science. And then returned back to university to doing business consulting, because I realized university life probably is not so interesting anymore as I thought. So much has changed, and that's the reason why I was going back to McKinsey then. After that, in 2013, I got bored again, because I was doing management consulting then for almost 6 years, being a senior engagement manager, so leading my own projects in different settings across the globe. And I was looking for a change, and the next natural thing for me was to become my own entrepreneur. And together with my good friend and colleague, Matthias Knecht, I founded ZenCap. So we took the last exit from business consulting to really doing something that changes things and that is more fun. And so we ended up founding ZenCap in the beginning of 2014. So the company is still rather young. It's only 1.5 years old. But it has grown nicely, as you would expect from a startup from Berlin. It's now 70 employees. It's present in 3 markets. We are in Germany, we are in Spain, and we are in the Netherlands. And we are nicely growing and hope to bypass 100 employees, hopefully sometime the next year. So that's on my background and the story how I arrived to do banking. And when people talk about banking, as you all have the stereotypes in mind, it's about math and it's boring, right? So that was the announcement. Actually, I have to appease you, so it's not about doing math all the day. I don't do that at all anymore. I just try to bring the story across that there is a big change going on in banking that we have witnessed before in commerce with types of companies like Zalando and Amazon, that we have witnessed in transportation with Uber, and that we have witnessed in the classical like logistics and hotels with Airbnb. So it's only the latest big revolution that is going on there. And as you all know, there's nothing new under the sun. So also not in banking. It's simply that Fintech is taking old services to the new world of the internet. So it's something like a merger of Deutsche Bank and Google you have to think of when you talk about Fintech. And big proponents who are writing about the scene of Fintech, they are saying Fintech is really the end of the old evil banking world. So it's something new, it's a big revolution that will take the old world of banking by storm. And that's what I want to tell you about today, what that whole Fintech revolution and that whole Fintech hype is all about, and tell you why it emerged against the background of a banking scene that is really in big, big trouble. So I will, in the first part of the talk, briefly talk about banks and where they are at the moment and why they are in so big trouble, and then go on to the new Fintech world and show you why they are newer. So we are talking about the old world of banking that in our view is really fundamentally broken. It's not in trouble, it's really broken. And you will see develop the scene against the skyline of Frankfurt, because that represents, in our view, best what the old world is all about. And when you think about the old world of banking, so when you interact with banks, how does that work? So there's one bank who has a branch and who's doing all the services that are related to banking in a way under one roof. So they hold your checking account, they give you a loan if you need one, they do your payments and process that, and they, once you grow a little bit in wealth, they will manage that wealth. So it's the classic universal bank that is doing all services under one roof, and that is therefore probably slightly inefficient. And on top of that, what is the defining characteristic of banks when you all think about banks? It's complex products. So what we have heard recently in the financial crisis, 2008, it's those very complex derivatives that, and there you really see the complex formulas and math that led the world into trouble. And that's a really defining criterion of banks. Next to complex products, a defining criterion of banks is they have a large physical branch network. So they are not tech, right? They are not in the internet. Where they are on the ground. They have physical branches everywhere. In Germany, it's 33,000 branches. So many branches across the whole of Germany, and it's 50% of all the cost that these branches account for from banking. So there you really see they probably invest in tech, but the biggest cost share that they have, it's their physical brands from the old world. So it's really 20th century. Let's now go on and look a little bit on the facts why the old world of banking is fundamentally broken from our view. So what has happened over the last year that we say there's something wrong with banking? We need to change it. We need to make it in a new fashion. First of all, what we have seen, banks have declared ethical bankruptcy. And if you open your paper every day, you see that banks are in real trouble there. A quote from one of our nice friends from Goldman Sachs. So he's the CEO of Goldman Sachs, Lloyd Blankfein. And there you see the arrogance that is coming into play in that kind of sector. So short after the outbreak of the financial crisis, he was asked, so what's the role of banking and classic investment banks in the financial world? And he's saying, I'm doing God's work. So we were just seeing a situation where the financial crisis had led to a value destruction that was equal to 50% of the overall GDP. 50% of world GDP was destroyed in an instant in the last financial crisis. In words, that's $29 trillion. That was wiped out almost in 1 year. And that guy is standing there and saying, okay, I'm doing God's work. So I'm the one who's really taking control of what is happening, and I'm leading a situation that is good for everyone. On top of that, and that is really what you see in the paper just recently, when you open them, it's banks are very heavy on fines. They pay fines like every minute there's a lawsuit, every minute you look around, and what you see here is an overview of fines paid by banks from 2014 and 2010. And it's an overall amount of 205 billion euros that banks have to pay in fines. Just imagine how many startups, how many universities you can build simply on the fines banks paid for misconduct, for misbehavior in breaking global rules that are there to stabilize the system. And on top of that, unfortunately, they are not only in ethical bankruptcy, they have a business model, and probably that's why they often refrain to measures like that. They have a business model that is really outdated. It's a business model from the latest century. And the problem with it is banks were earning a lot of money in older times. They were really the ones who were getting big profits. What you see there is just a short overview on return on equity. So what does the money they put in as a bank, their own money, what does it give you as a return? And probably some of you remember the infamous Josef Ackermann, who was like trying to get 20% return on equity for the Deutsche Bank. So that was probably a little bit high on the estimates, because on average banks earned 7% in the 70s to the 90s, then down to 5%. But now the system is so complex and so drained by competition that they don't earn money for their shareholders anymore. So big problem on the business side. On top of that, and that's coming back now to the branch network I was mentioning earlier, they are really stuck in an efficiency trap. So when you look at banks, they spend a hell of a lot of money on getting consultants in who help them to become more efficient, to cut costs, to be really the one who is improving the business model by slashing costs. So the classic work that business consultants quite often do. But you can see here from that graph, it's not successful. So they're trying to cut costs, but on the other hand, they don't gain in efficiency. So what you see here is the cost to income ratio with what you measure the efficiency of a bank. So what relation does your cost have in relation to your income? And there you see it's more or less constant, slightly fluctuating around 70% since more than 40 years. So despite all the programs and all the focus the banks are putting in there, no gains in efficiency. Even worse, banks don't innovate. There is no innovation coming from the banking sector. The only innovation we were seeing the last time in the 90s was derivatives, or in the 2000s, and we all know where derivative led us to. Straight to the financial crisis, because we were building like mortgage structures in the US that destroyed the financial system. But let's think back to the real innovations they made in the last century. And probably some of you remember those guys. Probably not the ones on the left, but the guy on the right. So 60s and 90s, what was happening there? In the 60s, the ATM was invented by banks. So really good innovation. We somehow found a place where you could take out cash money without being restricted to the opening hours of branches. In the 90s then, the next step, online banking was invented. I think two really great inventions that I use all of the time. It took banks 30 years to do that step from inventing an ATM to going to online banking. Now, 2015, the world is still waiting for the next innovation. Nothing we see that is coming out of the banking system at that point in time. So if they really want to survive and be as dominant as they have been over the last century, and banks really have been the dominating players during industrial ages. The industrial ages, other than the second machine age, so the first machine age, was really determined by banks. Banks were the driving forces in making traditional capitalism grow. Without banks, the kind of capitalism we are looking at now, the global kind of capitalism, would not have been possible. But that is over now, and banks need to adapt, they need to change if they want to be as dominant or at least survive over the next century. At the moment, it's not looking good, because people like you, people like me, we don't trust banks anymore. And you see that here on latest figures from Net Promoter Score. Net Promoter Score simply asks one simple question: would you recommend the bank you're working with to your friend or family? And it's from -100 to 100. The people who promote you, if all the people would promote you, you would be at 100. If people say, no, I don't want to recommend, you would be at -100, and then you would be bad. And what you see here is a comparison to already give you an overview or an outlook on the fintech industry. You see banks in Germany versus the two biggest fintech players in giving out loans, doing crowd lending or crowdfunding, what we will cover later. And you see banks in Germany, 10% Net Promoter Score. The new players that now arise, they really put the people back into the focus, with the result that people trust them. People start to trust not their bank, but their alternative provider of financing solutions. 79% Lending Club, 89% Funding Circle, player from Great Britain. I will talk about them later. And there you see, it's only going up to 100, and it's really a lot of trust people are putting into those alternative players that now emerge and drive that fintech revolution that is going on. Banks, on the other hand, they are really caught in restructuring. Latest estimates by management consultancy Bain tells us at least 10K of the 33K of branches in Germany need to close down, and at least 125,000 people will lose their jobs out of the 600 we have in that sector. So 1/5 of all the jobs banks have created are at risk at the moment. So it's not only bad for the banks, it's also bad for the people who work for the banks. So what we need to provide now, we need to provide alternative solutions that also have new modes of employment for all the people who have previously worked with banks and who now need a new job. And now let's flip that on the head and let's turn to the scene of Berlin. And Berlin is not only the driving force now in German fintech and European fintech, it's also the tech center and the startup center that we have in Europe. And as in other sectors and industries, it's in the end not traditional players, not traditional banks who will drive the change that is needed. It will be new entrants, new companies that will make the difference. And that's nothing new, right? We have been there before. I've mentioned Uber, I've mentioned Airbnb, I've mentioned all the other ones. So why wasn't it Sony Music that created Spotify? Right? It's easy. They had all the resources, they had all the knowledge, they had all the intellectual property. Why weren't they able to find a great solution and a great product like Spotify? Why wasn't it Sony Music? Same thing when you look to the DVD industry. Why wasn't it Blockbuster, the biggest DVD chain in the world with more than 5 billion of revenues, who was able to revolutionize the old sector? Why was there a new player like Netflix who need to come up to really bring into innovation into the sector? Again, why was it not Walmart who created Amazon? Why was it a new player who was entering the scene? And you can find many, many more of these examples, because so many people, when you talk about them, about innovation, that innovation will be driven by big companies who have the big R&D budgets. But that's not the case. Innovation over the last years, over the last couple of years, is coming from the internet industry. So internet industry is really driving innovation across all the different sectors that we are seeing. So the second machine age is not inventing a new industrial revolution. It's just taking products that are well known to all of us to the web, to the mobile device, right? The next step is not only have it on the web, it's have it on your cell phone that you have with you all the time. That will be the next big step that we will witness over the next 10 years. And it's really a defining force of that new kind of revolution that we are seeing, that it's never the old companies that are quick enough to innovate. In earlier times, you had like 10, 20, 30 years to go for innovation. Now innovation cycles have become much shorter. You have to be fast, you have to be agile, you have to be there within 5 years. Right? You cannot afford to have those long production cycles and planning cycles of 5, 10 years anymore, because then you're simply behind the market. And that's really a defining criterion that we see. So what's the secret? The real secret of that success? The real secret of that success is twofold. One, we have already seen, best customer experience. For the first time now, the customer is really going to the forefront of the development. It's not about innovating from the inside of such a company, it's innovating for the customers. So all the internet companies you're seeing that are successful, they build the best products for you. It's like intuitive with Apple. Right? You have your iPhone and it's all intuitive. You really like it and it's a great customer experience. And on top of that, all of those providers, and that's a really big difference to the first machine age, they are asset light. They don't have the big factories out there. They don't have the big branches and brick and mortar buildings. They don't have that anymore. So if you look at Uber now, they are one of the biggest transportation providers in the world. Not here in Germany due to regulation, not in France due to regulation, but elsewhere. They don't have taxis. They don't have even employees. They are just a marketplace. And this is where all the success is coming from. If you look at the successful companies that were built over the last couple of years, it's marketplaces. Marketplaces that connect one arm of a market with another arm, a customer with someone who wants to sell. And that's the simple and brilliant idea of Uber, that's the simple and brilliant idea of Airbnb, who simply connects people who say, okay, I have a flat where people can sleep, I just have it on the marketplace, and other can say, okay, I want to live there for a night or two. And that will be the same now with banking. That will be the same with financial services, where the fintech revolution that is now ongoing will take that old world of banking that I just described by storm. And now what is fintech? So what is really going on? As I said earlier on, you can picture us as Deutsche Bank meets Google. So you have the fin part on the one hand and the tech part on the other. So the tech part is really about the internet infrastructure. It's about cloud computing. It's about big data. It's about open APIs, so the connection and interfaces you build to other providers. It's about algorithms, the so-called algo banking that you're doing there, that you don't have people who decide whether to do the loan or not, but smart algorithms who do that. They harvest the web for data, and then they make better decisions than the old credit analysts did, simply based on data. And that now is crossed with the old financial world where you have like insurance, asset management, and all that stuff. I mean, everything that you use in your daily banking life. So fintech was really niche in 2008. And what you can see from that, again, innovation cycles are really short. Here is global fintech investments between 2008 and 2014. In 2008, you had 859 million globally invested into that industry. To have a comparison, that's about the startup scene in Germany. So the whole startup scene, the whole startup investments in Germany are around slightly below $1 billion, and that was the global fintech scene, where you had the Silicon Valley in, you had London in, you had New York in, so all the really big fish there. But then it was really moving up in 2013, already almost 4 billion. And now look at the last year. So it was jumping from almost 4 billion to above 11 billion. So it's a growth of 200% in just 1 year. And there you see it really arrived at the mainstream. It attracts a lot of money, and it's really going into all the different areas that you see in banking. I want to take the time and give you an example to make it more precise and more tangible from my own industry, which is lending. And again here, lending in the way of giving out business loans. So how was that organized in earlier times? How was that organized in the 19th century? In the 19th century, when you think back, there were the Volksbanken who invented that great idea that you can lend in direct communities. So there was a peasant who needed a new horse, and what did he do? He didn't go to his bank, but he asked his community to provide the loan to buy the horse. So you really had that local connection, a local marketplace where a lender and a borrower met to finance the horse. What happened then with industrial times? So the world got more complex, it got more from the regional level to the national level, and you needed banks suddenly, because those small local communities didn't work out anymore. So you had to have a bank that organizes that kind of lending that was going on in local communities before that. That was in the 20th century. And now when we go to the 21st century, we are back to square one. So we are back of the type of direct lending that we were seeing in the local communities in the 19th century, but on a global marketplace. So there you had the regional model of the 19th century, the national model, and then really the global model. And what you now have, you have a global marketplace where borrowers who need money, small businesses who need money, meet with investors like you and me. So in our product, everyone can invest. You can say, I have 100 euro on the side, I want to invest that in small businesses. You can say, I have 1,000 euro on the side, I want to invest that in small businesses. And I don't need to select them and run around and look at the different businesses I see here in Berlin. You can select from a wide range across Germany, which is pretty nice, right? You don't have to invest a lot of search costs if you want to have that new asset class. And now it really gets into the banking world about asset classes and what that brings to you about diversification, but I will not go deeper into that. So let's look at that marketplace lending, how big it is in the foreign world. How big is it in the UK, and how big is it in the US? And there you see it was tiny. It was tiny in 2010. It was tiny in 2010 in the US and the UK. For example, it was at 153 million only in the UK in the US in 2010, 5 years ago. Now you look at the market today, and you see it's at 11 billion. So it was growing yearly on a constant base of 140%. So it's really moving into the mainstream, that kind of model that people meet on a digital, on a global marketplace where someone needs money and someone gives that money in a private relation. No banks need it anymore. You really take the fat cats in the middle, you take them out. So what's the outlook for that kind of business model? The outlook is, and that's again a friend from the US, it's Larry Summers, the former finance minister and president of Harvard University, who recently got engaged in the scene. And he's telling us online lenders will capture a market share of 70%. So that really shows that banks will go out of business, if that is true, very soon. Of course, banks see it differently, but here you see someone from the old world who's telling you that this is a real threat and a real revolution that is material. It's not some startup guys in Berlin in the Silicon Valley talking about their great vision that will change the world and will materially impact banking. It's the old guys who say the same. And when it reaches that point, you always know there's something about it. Probably it's not 70% in the end, it's probably only 30%, but still, that's a big change. So let's compare that. Let's compare two big players, one well-known from Germany, Commerzbank. Market capitalization, so the worth of the company, the whole Commerzbank, the big international bank, founded sometimes in probably the 19th century. Market capitalization of 19 billion US dollars. Next to that, a company probably none of you has ever heard of, Lending Club. It's the biggest player, the biggest marketplace lender in the world currently. They have been founded in 2007 only. So they are just 7 years old, and they are already almost a half of the worth of Commerzbank. So these players, they are not that small niche players anymore. Lending Club by now, within 7 years of existence, has made it into the top 20 of the American banks. And those of you who know about the American banking sector, it's huge, right? And these guys made it in 7 years what others only could do in 20, 30, 50 years. So there again, you see the pace of innovation in that second machine age we are talking about. It's all so much faster. You don't have time to adapt. There are new players who disrupt quickly, and they don't do it in 20 years, they do it in 5 years. If we now look to Germany, here marketplace lending is still in its infancy. So it's really tiny. We were doing the last year ZenCap in Germany, and also we have Spain in there and the Netherlands, so all our markets. We were just doing 12.8 million. That's probably the equivalent of a small branch somewhere out there in Brandenburg is doing every year. But all the big players we were talking about, Lending Club I just showed, Funding Circle just showed, they were tiny in the beginning. They were even tinier than we were in markets that are much more conducive to that kind of online lending because people have a natural tendency to be more online. So there you see it all starts small. And this is the big danger for the incumbents that are out there, for the big players that are out there, because they look at it and say, 12.8 million, that's ridiculous. That's probably my lunch bill. And before they have really figured that out, it's like going fast and they are too late. And that's the really nice story that you have with the internet innovation, that incumbent players don't react quickly enough, and then you capture the market share in an essence and they cannot react anymore. So why are these marketplace lenders so successful? What do they do differently than your traditional bank around the corner? Why don't you not go to your traditional bank? Why doesn't the bakery shop around the corner doesn't go to the traditional bank? Because they are trustful. It's not a small internet company where no one knows about. First of all, it's great service. Again, putting really the people back into the center of the story. We are available 24/7 from everywhere, right? You can, if you want to apply for a loan as a business, you do it from your home, from your office, whenever you want. You just fill a simply online application within 10 minutes, and it's all fully mobile optimized. You can do it from your smartphone if you want. So next to great service, it's the ease of use. We are fast. We decide within 48 hours because we really know that speed now and those times matter. You cannot take time for like 2 months, 3 months to evaluate a loan application of a small business owner. Just imagine you want to run your bakery shop and you want to open a new store, and then you're uncertain for 2 months, 3 months whether you get the funds for that. It's simply not the time for that anymore. And then one very important last point is specialization. When you remember the very first slide I was showing, it was all about universal banks, so all the products under one roof. And that is again a defining criteria of that new machine age we are seeing, that people don't focus on doing everything anymore. They focus on doing one thing really good. We only do business loans. You cannot open a checking account with us. You cannot apply for a consumer loan at ZenCap. And you cannot do any wealth management with ZenCap. We are just a specialized provider for business loans. We do one thing, and that we do better than everyone else out there. And this is really the difference to the old age. We break up the value chain that was combined under one roof in earlier times, and now it's breaking apart into very, very small sections where you find agile players who make the difference and steal something from that value chain where banks can never compete on. Because they always have to bear in mind the whole value chain. They need to do good wealth management. They have to be cutting edge there. They have to be cutting edge in providing a checking account. Probably some of you have heard about number 26. Just around recently, one of the most modern checking accounts that you can find in Germany. Just around for 6 months. Right? They really focus on delivering the best experience on a smartphone with a checking account. They simply do checking accounts, nothing else. And that is really the difference that you're seeing, that you have all those players just taking a small chunk and being very good and fast on that. I think that we can jump over. Let me jump to the conclusions. So what's next? Where will that lead to? So we have learned that banks are in trouble. They are slow. They are old. They have deep problems with their business model. On the other hand, we have seen fintech companies like ZenCap, like many others, like Lending Club out there that are agile, that are really changing the scene for the better. But where will that lead to over the next, say, 10 to 15 years? What will the banking sector look like? 3 prophecies on that. First one is the classic universal bank that was the defining characteristic and the defining criterion of the 20th century capitalist age will die. We won't see those integrated Volksbanken, Sparkassen with a big branch network across Germany in the next 20 years anymore. It simply won't happen because their structure, they will never be able to compete on all segments with those agile players that pop up there. But on the other hand, fintechs shouldn't be too happy too early on, because currently there's a hype going on, right? You literally see a new fintech company every day, every other day that is founded. I just put some of the big players up there, and it's way too many. Because when you look at marketplace models, it's different again from the old world, because there's not 20 marketplaces that will survive. Those marketplaces are inherently global. Inherently global means that you will have in the end 2 players, 3 players, probably 5 players. In other sectors, not banking, so look at transportation, Uber, you have 1 player. Look at hotelry, you have Airbnb, you have 1 player. So marketplace has the inherent monopole problem that in the end you will have 1 global provider, or in banking probably because it's a little bit more complex, 5 providers that are out there. But you don't want to have, or what you won't have, is 1,000 banks. At the moment in Germany you have more than 1,000 banks. Right? No one knows. But that will not happen with fintech anymore. It will consolidate, and most of the companies that are now created here in Berlin, in London, with a big hype, they will vanish over the next 5 years. So what will be the common ground between old banks and new fintech players? So what I will see, and I think I will see, is that we have banks that are very good at one thing. They are good in providing cheap money. No one in the world can provide money as cheaply in the current situation as banks can do. No fintech player can do that because they are dependent on private investors who always ask for risk premiums because they are unsure. In the current banking world, central banks provide so much liquidity that banks are really strong at that. So what I think we will observe over the next 10 years, 15 years in banking, that those banks, those old banks will survive, who are the ones that open up their IT infrastructure. So now it's again about tech. The ones that build the best APIs, so the best connections to all those fintech players, because as I said, fintech players don't do everything well. They are just specialists for one segment. So the bank that will manage to combine them all in an open IT infrastructure, these will be the most successful. So then you have your number 26 sponsored by, let's take Sparda Bank, a very nice bank. So you have your number 26 with Sparda Bank. You're just a customer of Sparda Bank, but you can use the services of number 26. You can use the services of ZenCap, you can use the services of Vamo, which provides wealth management. And those banks who will be able, and this is a big task for them because their IT infrastructure is old and is plagued by historical decisions, those of them who will be able to open that up, to be really the forefront of the tech, they will be the successful winners of that kind of change that is now ongoing and will change the banking forever. Thanks.